Okay, hi everybody. Thanks for joining. Today I'm talking to Tim Hutchison, commodities trader for his company, Ranges Edge. We're going to start off. I'm going to let him introduce himself, and then we'll get into some questions that I have for you, and then also some of my students had for you as well. So yeah, let's jump in. I guess maybe first just kind of introduce yourself, what you do, and kind of the basics of how you got there.
Sure. So I've been in the commodity business for 35 years. Started straight out of university from Ohio State, where I had a degree in the Bachelor of Science in Agricultural Economics. I joined a company called Louis Dreyfus in 1985. The industry's gone through huge shifts over that time. When I first joined, it was sort of the specialized little backwater of the financial world, and it was in I came in the tail end of the glory days of the great Russian grain trade and the great Russian grain robbery. If you want to read up on that, Merchants of Grain is a book that describes the 5 shadowy privately owned companies that handled all these millions of tons of transactions.
That's called Merchants of Grain?
Yes.
Okay.
Yeah, Daniel Markey, I think. Dan Markey. Don't quote me on the author, but Merchants of Grain, you'll certainly find it.
Okay.
And I was fortunate enough to join one of those 5. They were called the 5 Sisters. Many of them have left, and others have come in to fill their voids, and the industry's become much more diversified. It's also during the late 90s, and back then it was really just all about moving grain from where it was to where it was needed, which is still very much the case today. But it was a very tightly controlled and held business, and it was, particularly the global trade, was dominated by five majors. Since then, commodities, and particularly starting in the late 90s, became more mainstream in the financial world. Goldman Sachs came out with the commodity index in which people can invest, and it coincided with the booming demand for commodities in China, concerns about future production. There's a whole storyline there. And the entry of the financial players had a huge impact on our business. I mean, it's a very small space, and the volumes that the financial world is used to being able to place into the market just absolutely overwhelmed us. So that brought quite a few changes. And I spent the first 25 years of that time working with multinational global trading houses and various corporate players. And their objective was, as I said earlier on, just getting the supply from where it is to where it's needed. There's a degree of supply chain management and risk assumption. There's a blend in those two things that go into that.
So you're primarily trading within the physical grain markets.
Correct. I've always traded in the physical space. And what I do now is different than what I spent across the majority of my career. So during my career, I acted as a trader for companies taking principal grain positions. So we're not brokers, we're not putting together deals or anything. We're actually buying the underlying product and selling the underlying product. Most of the businesses in that space today are quite focused on supply chain management, and that's how they view that they're going to make their living, by just being efficient and good at managing the grain down through the supply chain.
Yeah.
Big companies like Cargill have an approach that, or a business model where they want to try to own as much of that supply chain as they possibly can. So they have the country elevator, they have the export elevator, they own ocean shipping assets, they might have an interest in the discharge port, one of the processor or the consumer at the final destination. Domestically, within the US, they do this, and globally, they do this. Um, it looks good on a whiteboard. You throw it up there, and you draw a picture of a smiley farmer out next to a corn plant, and then little trucks and train tracks and barges, and put smokestacks at the fire and everything. The trouble is, there's an assumption in the general business community that if you do something, you do it for positive margins. Commodities regularly trade negative margins. So what is not really discussed at investor presentations or when people are looking at this is that you're not clipping the coupon at every transaction. There is a fierce competitor everywhere along the way. Commodities by their nature, highly interchangeable, easy to enter and exit. And some of those components are going to trade negative. And you look at the financial press of the Cargill family members that have owned it. They're pretty unhappy with their returns. They're pretty ordinary over the long run, because the reality is markets are efficient, and there's competition. New entrants, oftentimes they may blow themselves up, but it doesn't change the fact that they're competing at negative times you. So it's a difficult space. And I remember. So what I do now is I am no longer working as a principal trader. So I advise medium-sized trading businesses in Australia who are undertaking that role on risk management strategies. And then one aspect of the grains or the commodity market, and I'm sure it's true of the others as well, like there is a wealth of published information, but to know what's going on, and particularly to understand basis, you really need to be involved in the trade, down at the grassroots level. And I advise clients who don't have the size to employ someone with my background and experience. So it works for them to get some of that, and then it works for me because I understand what's going on in the space because I'm talking to them, and I try to organize my clients in such a way that I can get the most information as possible without them competing. And then when there are interesting risk profiles, I will try to go to a hedge fund and get them engaged because they want price risk. And the hedge fund experience with commodity risk has been generally an unhappy one because they're just sitting there trying to speculate futures behind a screen where they have no real advantage. They might have the latest mathematical model and it works for a period of time, but then it doesn't.
Right.
Whereas if you look at basis and understand the processes of delivery, market, physical, and futures convergence, you can assume a position that has a fairly certain outcome. That doesn't mean it doesn't have risk along the way. It has significant mark-to-market risk. It has significant financial funding risk. And that's highly variable. And in the early days of the grain trade, companies that was a big part of what you were doing, was assuming market risk. And it's still like, guys like Cargill or ADM still do take on enormous amounts of risk, and they manage it, and they manage it well. But if you ask their senior management why they're doing that, it's because they want to drive it through their asset chain and maximize their return out of that. Whereas if you'd asked some of the senior management 20 years ago or 30 years ago why they were doing what they did, they would say, well, we do this trade and we do it better than everybody else, and we get rewarded for assuming risk. And the mindset has changed on that, but the requirement for that function has not gone away. And it's left a gap in the marketplace. Hedge funds are the logical ones to assume that risk. they want to do it, but they want to do it the easy way, which is tapping in keyboards on a computer screen.
Yeah.
And the world does not need another speculative trader tapping in behind a computer screen. The
Right.
world people, investors willing to assume price risk in the physical markets, because the physical markets, especially in agriculture, are seasonal. We grow it once a year, we consume it for the entire year. So the market has to balance that out, and it does it through a price curve. And that's what I focus on, is when has that curve gotten to an extreme that there's a nearly certain payoff at some point in the future.
And that price curve, is that something that you can visualize?
Absolutely. So the physical markets trade predominantly in the nearby months, but they do trade further out. Particularly consumers, I mean, they're generally trying to buy their next 30 to 90 days worth of requirements. They're also very aware that during new crop, prices become depressed, and oftentimes, like Australian wheat will harvest in December and January. We already have some Asian buyers that are looking to buy new crop Australian because the price is depressed and they like that. The sellers, if they're farmers, there is growers selling a new crop today. They like the price, therefore are contracting it. And then the balance mainly occurs nearby. So trading businesses are there to bridge that gap. If there are more sellers than there are buyers on the day, the curve will widen out until traders view that it's gotten cheap enough that they'll take ownership of the nearby and carry the grain. And someone has to carry the grain, because once again, you grow it once a year, you consume it across the entire year.
Right.
So either the farmer carries it because he's unhappy with the flat price or believes the flat price will increase in the future, or a trader carries it. Traders do carry grain flat price as well, but the major guys with the big integrated systems, I mean, the risk of just owning it would be unmanageable. So they hedge it. They buy the nearby physical, and they sell futures markets, and they spend a lot of time trying to get that equation right.
Okay. So I guess I forgot to mention this at the beginning, but you're based in Australia. I'm wondering if the trading you're operating within is primarily the Australian market, if you trade in the American agricultural commodities, and if there's any advantage to being physically located in a certain spot, in how that helps with your trading strategies.
Yeah, look, because the risk management derivative instruments that I use for Australian physical product are predominantly U.S. and North American and European futures, there's a disadvantage in not being there in real time. Although I think I've worked in both markets, and I have also learned that just because you're sitting behind a screen watching the values change doesn't really mean you have very much control. You're just an observer with a stake, and oftentimes, in fact, the majority of the times, I think I get better placement because I put orders in before I go to bed. The markets have also evolved to more 24-hour trading. It's not full on 24-hour, but we can trade the U.S. futures during our time here, our day here. They're not as liquid. There's not as much price discovery occurring during that period of time, but it can be done, and that's where a lot of where my clients lay off a lot of their risk is during that period of time. For larger orders or for more speculative orders, place those in before going to bed. And as I said, I think most of the time, if you just look at a chart for a pattern, put something in, you end up getting a better feel than if you're sitting there watching. Or at least for me, I don't have the nerves of steel to just sit there.
Right.
Yeah. In terms of time zones, I think the Europeans do a very good job of their flat price trading, and I think they're kind of in an ideal location. Most of the agricultural commodities are U.S. based, so they've had a chance to come in, organize their day, have a chat to people, think about things, and then around midday, the U.S. markets open up, and they can do what they've got a game plan, and they can execute it. U.S. traders are coming in, a million things coming at them, and then there's some markets open,
Yeah.
and you're active. And here you're either up at 2 a.m. in the morning and not particularly cogent, or you're doing.
Right.
There are times when being there in real time in the U.S. is an advantage, and you can take advantage of some things that are unfolding in front of you. How significant that is over time is debatable.
Mm-hmm.
Just a little aside, when this would be going back into the late 80s, early 90s, there was a Chicago weatherman named Tom Skilling who would have his noon weather update, and it was also widely known that he was a speculator in futures, and he bet on his weather forecast. So during the growing season, this was very important to the marketplace, and this was also back in the days where if you wanted to put an order in, you didn't type it on a keyboard. You called up your broker, who called their people on the floor, who flashed it over to a guy in the pit, who then executed it.
Mm-hmm.
And, I was working for major companies, so we had our own guys on the floor, so we had shortened that communication string. And Tom Skilling would always have a little brief teaser before the commercial ad break of his forecast, and then he'd come back and give the full thing. We had a television in our trading floor, and we would watch Tom Skilling, just like everybody else in Chicago. And, if you understood the background, you could listen to the teaser, call your guys on the floor, race an order into the pit, and get it executed before it all happened. And, you could front run his forecast and make money.
High frequency trading.
That was high frequency trading.
Wow, that's great. Very good. Yeah, so let's see, another student question. When trading internationally, and maybe particularly with some Eastern countries, Asian countries, how often and to what extent do you adjust your presentations or business plans or styles to kind of mesh with other customs?
Yeah, look, in terms of the actual nuts and bolts of presentation and business, not very much, but relationships are extremely important. So, what you do adjust is the amount of time you spend just on, the formalities of the culture and getting to know them, and going out to dinner and bars afterwards, and all of those sorts of things. And like those relationships take time to establish, but once they are established, there is a degree of loyalty that exists. Although one also, from a Western perspective, it depends on the size of the company you're dealing with as well. But like if you're dealing with a large corporate, it's not you. It's who you work for, and once you don't work there, your best mate. Yeah. So what? Whereas medium-sized companies, it tends to be more personal. Although once again, that's because the person they're dealing with is the owner or manager of the company, and it's an ongoing thing. But one thing that is quite important in all of that, though, is some of those cultures, it's not unique to Asia, although many of the third world developing economies, a contract is viewed as a very fluid thing that, well, we've got this thing, but if circumstances change, of course, you'll help me out. The price has gone down, so you're making lots of money on this anyhow, aren't you? So you'll just cut the price. You do need to make it very clear up front, even if it might be perceived as rude, that contract's a contract. And particularly in my style of trading, where you are using futures to lock in, the day you sell that grain to them, you bought futures. So if the market's dropped $100, futures market's probably going down $100 as well. So if they want to renegotiate the contract, there's nothing to renegotiate. And oftentimes their form of renegotiation is just not to perform. But the best way to avoid that is to make it very clear from the beginning that, and it doesn't mean being rude. Just explain how you manage your risk and the importance of performance. And it's not what may be a centuries-old tradition of renegotiating these things. It's just not going to happen.
Yeah.
One thing on risk is, I think, and it's amazingly simple and amazingly poorly followed. It's just a matter of thinking about it, preparing, and oftentimes avoiding. And I think avoidance is sometimes the most powerful component of the entire mix. Like if you don't understand a risk that you're assuming, don't take it. And I'll give it a very specific example in the grain. Well, we can go back to the crude oil. Anybody that's carrying a position to the second of the last day before the contract expires should understand everything there is about that contract. You are now in the delivery period. So, if you don't understand what you're doing, you should have avoided that space in the first place. The rumor is, and I don't know if it's true, I haven't really spent much time trying to find out if it is that it was an oil ETF. So it's an exchange traded fund where, the investor who just wants exposure to the price of oil has bought the fund. Well, I don't really know why that fund, and I am a little bit skeptical about whether it was an ETF, because usually that sort of instrument would not be allowed to go that close to final delivery. They would have to exit before you enter the delivery month. But crude oil is liquid, and maybe they don't have those sorts of constraints. But the people that were managing that fund had a fiduciary responsibility to the investor to give them exposure to the price of oil. And while the cost of storage and handling is a component of that, it's like the people didn't buy that because they wanted exposure to the price of storage and pushing Oklahoma. They wanted exposure to the price of crude. So the guy that bought it needed to understand what the terms of the underlying contract were, and the guy that's selling the service likewise needs to understand it. Neither one of those parties can do that. It would have been better for everyone concerned if it had been avoided. In terms of there's a company in Australia called Sydney Airports. So they own the airport. They do parking. People pay them to have the duty-free shops and all that kind of stuff. They've got a monopoly. Very low risk. It grows with the economy. They have pretty consistent return on capital around 5 to 7%. Great utility. It's going to grow, return 5 to 7%. Should be a wonderful investment. But because they're a monopoly and they have these assets, it's pretty easy for them to borrow money. So their historical returns are not the 5 to 7% growth on capital, but they've tended to be more like, I can't remember offhand, but I think it's close to 20%. So they've leveraged and geared themselves up to the hilt. So, yeah, anyone with, and look, I'm not an accountant, but anyone with any grasp of finance understands, like, the amount of debt to equity in that company is just massive. Yet it's been purveyed to retirees in Australia as a really wonderful place to put your money because you have this great dividend yield and everything. And so now the same advisors who have been recommending this for years have now, in light of the Sydney airport cutting their dividend to zero and the share price collapse, saying, well, it's not really what we thought, and they have a lot of gearing on their balance sheet, so you should sell them. Like, these are mainstream, widely followed advisors, and it's kind of like, guys, you should have avoided that from the beginning. And like, there's no mystery they had debt. So, you didn't plan, you didn't prepare, and now after the fact, like, the reality is, yes, shares go up and down, but now you're telling people to take a huge haircut on their investment because it has excessive gearing. It had excessive gearing 6 months ago. There's nothing new about it.
Excessive what?
Gearing, leverage, financial borrowings. Yeah. And, once again, and this goes back to the question someone had about your own money in the market versus just being compensated on performance or something. If you think about the financial markets, and because I do have the hedge fund involvement, and the service that I'm trying to sell is reward for assuming risk, I'll admit that I have a bias that I think the kind of risk I'm selling is one that hedge funds should be willing to take on, and it's superior. But if you think about the idea that investors are locking in negative bond yields for 10 years, it's like, if it was your own money, would you really do that? Would you think it was a great deal to shell over your cash and get less back in 10 years? And I mean, I know that there's all sorts of portfolio analysis that can tell, why that's good, and you have the security of government debt. And look, as long as interest rates have been falling and continue to fall, even if they continue to get increasingly negative, look, that's been a great investment. But it's a trade. It's not an investment. And if the product that you're ostensibly marketing is a long-term horizon investing portfolio, why are you engaged in a trade? It's not an investment. It's a short-term trade. So you're saying you're going to take long-term money because I can make short-term bets better than other people. That's bullshit. And it is a failure of the market, and it's the outcome of people investing other people's money. Like, there's no excuse for being so lazy that to seek a low risk return, I'll take negative, and there are other things that are also nearly as risk-free that would give a positive return, but they're not being pursued. And then you can get into yes, but those things can't handle the volume of cash that I want to place. Well, if that's the amount of cash that you've got under management and you can't place it, perhaps there's a structural problem, a systemic problem. Right. So students can go out and tackle that.
So what?
You and your students can go out and tackle that one.
Oh, there we go. Yeah. That's actually where I was thinking maybe to transition for some few last questions. To kind of talk about what have been some of the most important skills that you've used in your career, and then maybe some more specific advice more directly related to current students.
Sure.
it sounds like you would potentially advise, or your approach, at least, is more of a kind of understanding the fundamentals,
Yeah.
less kind of quantitative, and maybe some different types of skills.
Yeah, look, I mean, my forte and my career success has been based on analytics, but that only takes you so far. Like, you have to have good people skills and good communication skills. I think I have the latter, not the former. One of the best classes I think I had in college was just a basic English writing class, and I guess the nature of the companies I worked for after Louis Dreyfus, it was oftentimes senior management was not trading background, whereas the business was trading oftentimes. So being able to communicate those concepts to non-traders and to get the risk was quite important. And that's both verbal and written. And, I highlighted before that I think there is a gap in terms of how the general business community manages their risk. So, people that can communicate that well have an opportunity. I also, and it might have been the nature of, the companies I've worked for and the kind of business I was doing, but one of the other college classes that's been fantastic across my career has been, I just took a basic contract law class. I just took it because it met an elective requirement at the time, but it was a great professor. It was very interesting, and those basics have been quite useful. In terms of preparing for your career, what you do, I think read widely and do something you enjoy. I mean, you're going to be doing it for a very, very long time, and if you're not passionate and enjoying it, you're wasting a significant portion of your day every day. It is a reality that a lot of people end up in large corporates, and there can be bureaucracy and frustrations that go with that. One thing I think I observed midway through my career is, if things aren't going exactly as you like, don't get too stressed. It'll change. You feel like you're locked in. Oh, my boss is horrible. I don't like him, or whatever. There's a tremendous amount of churn. So I think don't get too disillusioned. Keep doing a good job at what you're doing, and if it isn't working out, you can change and jump. But and this is speaking for someone who did jump a few times when I was younger. Look, I think in the long term, those have all been good. But also looking back, it's like, what, if you just stayed there a little bit longer, it would have changed.
What's that? What was that last part?
If you'd stayed there a little bit longer, it would have changed.
Oh yeah.
But look, it's an adventure and a journey. In terms of preparation, people are genuinely interested in getting into grain trading in that space. The big corporates own, like Cargill or these guys have country elevators all across the U.S. They need people to come in and manage those, and they do, I think, still delegate quite a bit of authority in terms of the mix of the products that are held there. The difficulty with those roles is to advance to more senior, heavy hitting trading positions, like, what I did in the past it's quite difficult. Like, there's only a very small number of their traders would be moving on to those levels. Hedge funds, if you're interested in trading large positions and sort of the glamour and stuff, I mean, they're there. They traditionally look at either liberal arts type graduates or quantitative guys. Then there's a whole list of, people that are businesses that have a peripheral commodity exposure that are looking for buyers and managers. And my experience, those guys are usually pretty frustrated because they actually understand the price risk that they're managing. Their managers don't, and it's a challenge for them. But that might be based on a small sample set. It's not valid everywhere.
Yeah. Well, yeah, this has been great. I guess maybe just one last thing, since you mentioned as one of your pieces of advice to be widely read. So you mentioned the first book. What was that called again?
Merchants of Grain.
Merchants of Grain. Do you have any other book suggestions to kind of wind us off?
Oh, gee.
Sorry, I didn't give you that one as a prepared question.
Look, I'm reading an interesting one at the moment, and once again, I'm horrible about authors. They'll resent this. It's called The Anarchy, which is about the East India Company, the British East India Company moving into India in the 17th century and on through, and how they just controlled this economy and had their own private armies and it's pretty fascinating. I'm not sure it's relevant to commodity trading, but it's an interesting
Yeah,
one.
no, that's okay.
Yeah.
Okay, yeah, great. Okay, well, yeah, thanks for taking the time.
No, happy to. Sorry to waffle on. I do get off course sometimes, but
Oh no, that's all right. Yeah, this will be great. Hopefully the students will enjoy it, and well, other people too, I guess, if it'll be.
Yeah. And look, if you have any follow-up questions or anything, I'm happy to to take those. Or...
Yeah, and I'll pass that request along, or that see if my students have any questions as well, and if they do that they really want to hear back from, I might pass them your way.
Great. Good luck to everybody.
Yeah, thanks.
Cheers.